Real mortgage questions. AI answers. One broker who tells you what it actually means. I'm Edward Brady, a chartered financial analyst and broker at eXp Realty. Opinions are my own and not that of eXp Realty, its management or staff. This is Mortgage Questions. Let's get into it.
ChatGPT answered the following question, which people have been Googling quite often: what's the best real estate loan? And can you compare, estimate, and look beyond just the rate? It's talked about FHA and VA loans and regular conventional loans and the response with new home buyers. What guidance would you give to them in deciding what's the best loan for them?
So when it comes to first-time home buyers, there's two things that a lot of people focus on. One, I want the lowest interest rate, and two, the lowest barrier to entry. So what are the minimum downs? That's great. A lot of people put a lot of weight in those two topics and having those two as the focus point. Looking at it at a different lens, what loan structure helps create a good cash flow system for them? Like I said previously, there's two brothers, maybe one has a better cash flow if they put more down than the other. So that's something we want to think about, is when we're trying to borrow smart, really evaluating loans through this idea of what's going to give you the best safety, liquidity, and returns. And your monthly savings can do it if it's invested instead of maybe being trapped in just equity in your asset or your home.
Okay. And what life situations would immediately steer you toward or away from certain loans?
It's depending on the client's scenario, because everyone's scenario is different, where one might favor some because they have more liquid assets that we could use and that we could be more aggressive on the down payment structuring. Others maybe are just very starting in early, maybe single person, couple who is just trying to get into that first family home and is just trying to make something work through a more savvy, maybe minimum down payment option. I always like to assess it and making sure the best loan option for them is the one, again, that's giving them that safety in knowing that they're not going to be just trapped in this asset or this home in the long run. And that if we're looking at their long-term play, it's going to help them hopefully cash flow or invest and then into that next property.
Low down payment loans are very popular on the internet. People Google it quite often. And the fine print usually means that there's higher long-term costs. And how do you help buyers understand the real trade-off between the upfront cost and the total cost over time?
It's knowing what their time horizon is. Is this, again, like a stepping stone property, or are we looking at it to really have the family forever home or the individual's forever home? And if we know what their plan is, not just for now and the purchase for now, but what they're looking to do in the near future, that's how we could best structure the best mortgage plan for them.
When does it make sense for somebody to do FHA or VA with as much down as possible? And when does it quietly become a trap?
So for them, I call it the home framework. And this is probably something we're going to talk about a little bit later, but I'll just mention it right now, is how strong is their home framework. And this is something I just taught a group of women over the weekend, really understanding their financial foundation, and then from there gauging where they're at in the home framework. And once we know that home framework, we'll know what's the best timeline for them of being an aggressive home purchaser, and then making sure that we have maybe more options provided for them. Or if there's something that maybe is a little bit loose in their home framework that we need to work on, and maybe we need to just be more cognizant of the structure and framework we go in purchasing for them. So one of it is knowing, can they support the product, whether it's a conventional loan, VA loan, FHA loan, and can they support that payment around it in the lifestyle that they want? There's no universally best mortgage, I'd say, or a timeline. It's matching the loan to the plan and making sure to avoid options that reduce their cushion, whether that cushion is, if they're looking at it in the lens of investments and in savings cushion, or just like their lifestyle cushion. That's what.
So one of the things that I thought is really interesting is that many times people don't understand that you don't necessarily need a ton of money to put down to actually buy a house especially with a FHA or VA option. They may not necessarily know what costs beside the down payment and what typical other than the down payment do people get caught off guard with.
Gotcha. So when we're talking about cost, the most well-known one when they're looking about purchasing is that down payment. Associated with a purchase transaction, there's more costs that people don't realize, but that's something that is obviously something they need to be aware of, because it will also play in a factor of how much liquid assets they have. A good amount of that is going to be those closing cost fees. Typically, a good rule of thumb we like to say is, whatever the purchase price is, just know that closing costs would be more or less 3% of that. And closing costs is an array of third-party costs and companies that help get the buyer from opening a contract to the end of an escrow period or contract period. And so they'll be able to have the keys to their home. A lot of those are any lender fees, any escrow fees, any title fees. Depending on some states, you might have attorney fees, as well as, if you choose, and it's possible, whether we're impounding your accounts with your taxes and insurance or not, those are just fees that you just want to be mindful of that's associated with closing costs. Other things we want to make sure that's, I think, prevalent in today is your homeowner's insurance is part of your monthly payment. And a lot of those fees, depending on the areas you're going to be looking to purchase in, whether it's in a flood zone, earthquake zone, high fire zone, those are maybe additional requirements that a lender might require you to get, just depending on the area you're looking to purchase in, as well as an appraisal fee. A lot of times we always like to let people know that typically an appraisal is a third-party report. An appraiser helps value your property. So if you're purchasing something, let's say, for example, at $500,000, they want to make sure that you're purchasing it at that amount and it's valued at the amount. So they're that third-party opinion that the banks will go to and that they will use to make sure that the property is worth a certain amount. And then from there, it's also making sure that, I know on the real estate side, you have home inspection fees that not necessarily on the lending side, but is part of a real estate transaction that a lot of borrowers need to know. And those could be an array of different home inspections other than the general home inspection that is required. That is just dependent on what the borrower would like to get done. I always say, or prior, it was usually a 2 to 3%, just with where a lot of fees and increases in certain areas, such as insurance and premiums and etc.
As far as lending fees, isn't there some document that they get at the beginning or at the end of the process before they actually close the loan?
You mean your loan documents?
Like a truth in lending document or something like that, where it tells them how much they're going to pay?
Correct. I always like to tell people you're going to get a loan estimate up front once we designate what house we will be purchasing and opening that contract with. And the best way, an analogy you could think about it is a loan estimate. Think about it as a rough draft paper. It has ideas of what your loan, what your terms may be, what your costs may be, but it's not the finite version of it yet. As we go through the process, through the escrow process or the contract process, you'll go from getting a loose rough draft numbers to eventually getting your closing disclosure. And this closing disclosure, once we finalize all the terms, any credits that are negotiated from the seller through maybe home inspections and or any lender credits, dependent on once we lock in the rate, we'll know the final rough draft number of your closing cost fees.
You're talking about the closing statement on the escrow now.
Yes.
Oh, okay. So now many people that are interested in these down payment loans, we're here in California. So then they have availability of CalVet and then of course FHA. Do you know what the current loan limits are for FHA and CalVet? Or maybe the best way to answer that is actually just give people a place to find that, because it's going to change, right?
Yes. So it changes every year. And sometimes the numbers, it depends if someone's buying in a high cost area, such as California or Los Angeles County. Some places in California are not high cost, so they'll have the regular FHA limit. So it's always a range. I could say, and it depended on what type of units they're purchasing. So if it's a single, second, 2-unit, 3-unit, or 4-unit, I could say it, or I could just designate like where they could look at it. And then so they know where to reference for whatever year they're looking at this podcast episode. If they're looking for what's the most recent this year numbers, so for 2026, you could go to HUD.gov, and that will give you for FHA government loans VA what those numbers will be abide by. As far as for Fannie Mae, Freddie Mac, you usually go to those are different standard numbers. So depending on the loan, I would direct them to HUD.gov.
HUD, right. And then for the VA, it would depend on their state, but for California, it would be CalVet, right?
Yes and no. It's just not necessarily like CalVet. It would be Department of Veterans Affairs. So basically just using the FHA guidelines is a good rule of thumb. And then typically VA will follow FHA guidelines.
Oh, I see what you're saying. So you're saying that if they're in California, then FHA has a certain loan limit, VA should parallel that.
Correct.
Okay, that's helpful.
It's usually the higher cost one. So that's what VA normally goes with. So that's probably why CalVet shows 1.2. So whatever the high cost limits are for each area or each county, it's usually what it'll use.
Oh, I see. So then the high cost one meaning the high loan limit amount.
Yes.
Okay. And what mistakes do buyers make when they're shopping around for the top of their limit?
Making sure that they're not over leveraging. A lot of the times I've seen clients where because of the markets they're in, they need to be maxed approved versus what makes sense to keep them in a safe range, mortgage payment. And for me, it's making sure we're not putting them in a worse position and not over leveraging how much payment you take on, because if that's going to eat up most of your living style and through living expenses. I don't want to have a client eating top ramen for dinner every night just because they want to really get into home ownership. It would be a disservice to them.
Yeah. So what kind of credit score would somebody need to get into FHA or VA loan? And what part of their credit score actually matter the most?
Great question. So when it comes to credit, and just to note on this too, for conventional, there is VA and conventional really doesn't have so much guidelines on credit, and there's some recent changes on that. It's now the lenders who set their individual credit guidelines. So your typical VA and FHA you'll see from most lenders, not the VA itself or HUD, 80. Then still you're seeing conventional loans anywhere as a tier of 620 minimum. Sometimes lenders, just depending on the client's risk profile, may be able to lend lower, say for FHA at a 500 FICO score. But now that may require you having to put 10% down instead of the minimum 3.5. So it just depends on the credit. There are some ways we could still work with lower credit scores, but just know that will come with more requirements, say at putting a little bit more skin in the game and having maybe a higher down payment.
Okay, so that makes sense. So when they say that 580 credit score, that's really if you want to maximize the amount of leverage that you're using, to minimize the amount of down payment.
Correct.
Okay.
And then for those where you can see lower down payments, one, it's typically at a higher or lower FICO scores. It's typically in lieu of using a higher down payment strategy for those borrowers. And then
Oh,
the second part to your question would be what affects your credit and what's the biggest impact. A few things. One of the things when you're looking at credit is no late payments or derogatory accounts that may reflect on your credit report, and making sure how recent were they. Did you have a late payment last month versus or did you have a late payment maybe 5 years ago? Late payments is a big impact when it comes to how it affects your credit as well as your utilization. So typically the good rule of thumb is having 30% utilization. But if you're maybe trying to be aggressive in how much you're purchasing and having the best credit score, always having at least 10% of a balance, or the best is always having no debt on your credit lines, would be preferred.
okay. So one of the things that with Google a lot with, and it's
hmm
often explained as part of the payment, which really oversimplifies the impact. And how should buyers evaluate whether they should get PMI, and how does that compare as far as the APR and monthly payment and the long term?
So think of PMI as a trade-off, and your trade-off is what you're trying to leverage. When you have a strategy where there's a loan that includes PMI, you might be trading off how much you're trying to preserve in liquidity or how much cash you'll have. Versus if you wanted to have an option that had a trade-off with no PMI, you're putting in a little bit more leverage to how much you're trying to put into this asset or this home. So is it worth protecting how much cushion I have for either having PMI in my mortgage payment, or would it make more sense to not have it because maybe I have tons of cushion or margin that I could maybe put more of a down payment and I'll still be fine in my reserves? Or would it make sense to maybe add on this payment of PMI, knowing that I will be depleting my reserves and my cushion? That's one way I would look at it, and seeing that it's honestly not that bad if you look at numbers and numbers and then just tying it in with the short and long-term strategy that someone's using. Because in their sense, if there's someone who's going to be maybe moving from place to place every 4 to 7 years, maybe just putting a little bit of down payment, right, as a trade-off and leveraging that risk, and knowing that you have other costs that's going to be coming up, or maybe sacrificing it because of other maybe milestones in life, milestones that you're going to have, whether that's preparing to have a family, preparing for maybe like a wedding, that someone needs to leverage for those milestones. PMI could be used for you in a good way, as long as you're structuring it with whatever life is happening for you at that time.
So basically liquidity versus necessity.
Yes, absolutely.
So I guess in that same line of thinking, I mean, a lot of people, they portray the conventional loans are often better once you qualify for them, but better how?
So when you're looking at conventional loans versus maybe other well-known first-time homebuyer loans, such as an FHA loan, they are a little bit more tight when you're looking at how much debt you could take on, right? Maybe they're more favorable if you have increased FICO scores or maybe more reserves, as well as maybe a safer option for those who have maybe more income. But better in this sense, is it a better way that you could use for cash flow strategies? FHA loans have upfront mortgage insurance as well as private mortgage insurance. So maybe it's a better way because you're cash flowing, not having to take on those extra costs. So the flexibility and maybe having those longer term, maybe better because the friction's not there. So it could be winning in that scenario and in helping you support whatever that wealth strategy is for someone.
Okay. So basically what you're saying is that you're going to have more cash flow. So because
Absolutely.
you're not paying the PMI, does it affect insurance or any other than PMI? No, nothing other than PMI. It's about having the lower down payment rather.
Not so much. Conventional a few years ago changed a little bit of the structure how their PMI structure works. So the only thing it would maybe affect is just the PMI it has. But for FHA loans, it's a standard ratio and percentage they use depending on your down payment. So one of the things you want to make sure is that conventional, even if you have PMI versus having a conventional FHA loan, if you both put minimum downs, either 3% for conventional, 3.5% for FHA, one of the beautiful parts of having that mortgage insurance on a conventional loan is once you have that 20% equity built up in your asset or your home, you can have the opportunity to take off that mortgage insurance by calling in your servicer. Whereas an FHA loan at that 3.5% down, mortgage insurance is there for the life of the loan. It's not until you get into that next tier bucket or when you have that equity built up in your property where you could refinance it into a conventional loan product or refinance it to another FHA loan if you wanted to.
Okay. So with FHA, you're saying that the insurance cannot be removed, or am I misunderstanding that?
When you put the minimum down at a 3.5% down, it is part of the life of the loan.
Oh,
Correct.
wow. I didn't know that. So that means that putting 10% down with a conventional loan and having PMI, if that's how much you're going to put down, actually could be an advantage or an FHA loan. Is that what you're saying?
Possibly. Now, if we're saying comparing apples to apples, if you had
10%.
that 10% to 10%, at that point in time, at 10%, we could later down the line try to refinance out of that PMI. But it's when you're using that minimum down structure of 3.5%, there isn't that opportunity to take out that mortgage insurance later on.
Right. Yeah, I thought of a scenario where that illustrates what you're talking about as far as the cash flow, because it's something I think about all the time as an investor, and that is, I don't want to have to put more money into the house every month. I want the tenant to pay mortgage, the insurance, taxes, everything, and maintenance too, which means PMI versus conventional could be a difference there, depending on the rents, of course.
Right.